This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on, though, to the post-game chart deck, which is titled Summer Doldrums. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click on the red button that says Looking for the Downloads. Patrick, Summer Doldrums, stock market anyway. If you're thinking that, you weren't trading commodities this week.
Oh, you know what? When you said that at the market wrap, I was like, yeah, maybe I should have thought about the title a little bit more, because I really was thinking about the stock markets when I was coming up with the title. But you're bang on, because when we look at the rest of the charts on here, we can see substantial volatility in so many of them. But what was really interesting is that what we have is in the stock markets, really the downside momentum has stalled. And there's no shortage of people coming out contemplating the idea that maybe a stock market bottom can form. And the interesting thought to me is like it is not out of the realm of impossibility for a market bottom to form, but we really lacked there being really one kind of capitulating event. And that doesn't mean a market bottom always needs one of those events. But the thing is that you also don't have a macro backdrop that is really supportive of sustained buying. And so to me, with both of those lacking, I still want to continue to, in the back of my mind, respect the primary trend, which has been the downtrend in play. What's interesting is that while we have rallied a little bit higher in the stock market, we haven't beat that little June swing high. But when we also haven't beaten fib zones, we haven't beat a 50-day moving average, we haven't beat the descending trend line. There really is no technical evidence that the bulls have put anything together. So it's an early speculation that bulls are betting on if they're calling the turn already. Now, the thought, though, in my mind is that what could really the market do that just creates the most amount of confusion and frustration in both bulls and bears? And in my mind, that would be the multiple fakeouts. So with this break to a lower low in June, if the market here temporarily worked its way north of 4,000 as the month of June just as a grind, and then offer some further volatility in both directions in August, by the end of it all, everyone's going to be so confused as to what's next in the markets that there will be a lack of conviction in almost everyone. I really am thinking, is that a real possibility? Now, before I get too neutral in that stance, we are approaching a very critical level here on the S&P. And if the bulls fail to legitimately clear 4,000 with any gusto, then I'm going to still stick by that the prevailing downtrend is the dominant trend that has to be respected here. What's your thinking?
Patrick, as I mentioned in the market wrap, the way that you know when a market has bottomed is when there is clear, decisive, bad news that comes out, new information that's bad, and the market doesn't go down on it. That means the market has just been exhausted. It's got no further down to go. There's no sellers left to sell, and it's all uphill from there. In some ways, this is kind of looking like that, but it comes at a time when I absolutely was not expecting it. I thought we were about to get an acceleration to the downside. Now, as far as what would really confound everybody from here, I think it would be if the market moved above the 50-day moving average, giving everybody a signal that, okay, the bottom really is in, and then we get the big dump from there. You could make the argument that we're seeing a bottoming process here, but boy, I sure wasn't expecting it. I thought we had much lower to go. What do you think?
Well, Eric, I just want to kind of think about it from one perspective. Like when we think back to David Rosenberg or many of our other guests like him that have often said that the Fed doesn't pivot until they break something. And the thing is clearly, as Jeff was telling us during the presentation, that there's all these indications that the Fed is going to, at some stage, stop rate hikes as we approach the tail end of the year. Exactly how it plays out is still to be determined. But I'm trying to imagine: does the Fed pivot without breaking something? And can the stock market be stable and rallying, and Powell just comes out and says, no, that's enough, and we're just going to stop raising rates here? And, when I put it in that perspective, I still find it very hard to want to kind of flip to any bull narratives. What do you think of that?
Patrick, I can't even think bull case because I was convinced that the market had much lower to go. But the thing I cannot explain here is the resiliency that we've seen in the market this week, in the stock market. And I don't have an explanation for that. What we know is that when you get bad news, the market's supposed to go down more. When the market doesn't go down on bad news, that's usually a sign that the bottom is finally in. Now, as an example of bad news, let's move on to page 3. We've been watching the euro-dollar cross, and you've been warning our listeners for weeks and weeks now that if it breaks below that support level, that there would probably be a sudden and abrupt acceleration to the downside. That's exactly what's happened in the last 3 days. You'd expect that signal to kind of tell the stock market, boy, dollar breaking higher, euro breaking lower, taking out critical support. Bad news, bad news, bad news. But going back to page 2, stock market's actually kind of up on the last 3 days. I cannot explain that. Can you?
Well, the stock market is sort of marching to the beat of its own drum temporarily. Inevitably, intermarkets do trickle their way through, and, investors don't care until everyone cares, and then they all care at once. And so you never know when the stock market will have some sort of reaction. But to the point, though, on the euro, it was a very important support line that we were testing through May and June. And this breakdown is some serious technical damage, which really puts us within a stone throw of that parity level. And I think that this is the bigger intermarket story when it comes to the commodities and things that we're seeing, whether it's gold or any of these other assets. Like, it's no coincidence that the euro breakdown corresponded with that big breakdown day in gold. And I think that the next real big moves in the US dollar are actually going to be critical for that bigger story, because generally a rising dollar has disinflationary or deflationary pressures that trickle through the whole system. And I think the biggest macro call to make is, when does this dollar move end? And I don't know whether I have a strong conviction to make that call, but the trend is very dominant right now, and there's no reason to immediately believe it's over. There is certainly, on the short term, at least on the Euro US, slightly oversold, but certainly nothing that comes jumping off the sheets that it needs to end tomorrow. And this I think is the chart to watch, because at some point, if the US dollar just keeps going, the stock market has to start to care at some point. Though, Eric, I want to move on to crude oil. And what a breakdown day we had earlier in the week. Just one heavy sell day that really, we haven't seen a big drop like that since March, when there was the reactions off of the Ukraine pop. And the selling was substantial. But in my mind, have really been watching more or less the 100 level as a nice clean round number, as sort of the arbiter of the trend. And to me, the real sustained selling happens if the bulls can't keep the price above 100. The fact that we rebounded it back above 100, in the back of my mind, still keeps the window slightly open that the bulls will be able to put something together here. We came to a pretty big high volume node consolidation zone from all the trading that happened in April and May. It'll be really interesting to see whether that sell-off the other day will be just in the end brushed off, and the bulls make it all the way back to 110 in the coming days. One way or another, the one thing I will say, the bulls, in my mind, need to erase that sell-off from earlier in the week very quickly to really solidify that the bulls are still in control. And so I'll be watching to see whether they can make it back to 108, 109. What are your levels?
Well, Patrick, if I look at this chart, it just says to me, boy, oil has entered a bear market. It's probably got a lot much lower to go. Sell the next bounce and get the hell out. But if I look at the time spread charts, they give me the exact opposite. We've gone substantially higher since the 14th of June, which is where the peak is on this chart, on time spreads, not lower. And that's because the physical market is getting tighter and tighter and tighter. So I'm convinced that the big sell-off we see here since the 14th of June on this chart is the market pricing in a recession. And I don't think the recession is actually going to bring the price of oil down. I think it's going to go higher during the recession, and I think the fact that it's going higher is going to exacerbate the recession and make it worse. But for now, everybody's on the old school logic is, hey, if there's a recession coming, surely that must mean it's got to be bearish for crude oil, so let's sell crude oil, and that's what they're doing. Let's move on to page 5 with gold futures. We're coming back down to that critical zone that we had on the chart from, a year ago.
Yeah, you were talking about that the 1680 zone in the market wrap, and I mean those lows from 2021 all were from those kind of key levels, and it's all within a stone's throw. And this is the interesting part. So the gold really has been acting as a cross currency to the US dollar. And when you look at the trends in the euro and pound or any other cross currency, you can really get a sense of the pressures that have been under, that gold's been under. And so as we approach these support lines, it'll be really interesting to see whether or not this becomes where all of the short-term lows on gold start to establish themselves. And more importantly, how fast do gold prices recover if they do bounce there? This chart right now there's no other way to put it, is incredibly ugly. And while I remain a bigger picture bull in gold, I can't say anything about this chart that is positive other than it's incredibly oversold and coming towards support lines. And for some traders that's enough. But I think that this is going to be a grind into the summer for gold along these support lines. And maybe it's going to be waiting until the late third and most likely fourth quarter to really potentially see any meaningful turn higher. That's at least my starting base case when looking at this chart.
Let's move on to copper on page 6. Boy, that sure looks like a reversal candle yesterday, doesn't it?
Well, yeah, but it was a reversal candle after an absolutely devastating downtrend sequence. I mean, we went from $4.50 to $3.25 in a span of like 3 weeks. It was just an awful decline in copper, one that copper hasn't seen in an incredibly long time. We're finally getting a short-term bounce, but after such a huge drop, this is a par for the course to see some reaction. We could even probably see 375 or 4 on a reaction, but this is now a very distinct downtrend, and it'll be really interesting to see what kind of follow through the bulls will be able to put together during this bounce, and whether it just stays very shallow and methodically sold, or whether the bulls actually legitimately put some money behind it and create a bounce. It's certainly a chart to watch into next week.
Let's take a look at 10-year bond futures. We look at the yield all the time. We're looking at the price this time. What is this chart telling us?
Well, Eric, I just wanted to put the 10-year bond future on to give us the inverse look of what we typically are looking at on the yields. And one of the interesting things that we're seeing is the potential turn in bonds. And one of the things that gives me that environment, that feeling, is that when you have a strong dollar and commodities coming off, it certainly could become some of the catalyst behind some disinflationary pressures. And if the market's starting to sniff that we've seen peak inflation, maybe the bond selling ends. One of the big things that I'm going to be watching for is that during this little dip, whether bonds make a lower low, or if they turn around and make a right shoulder of an inverted hen shoulders or double bottom formation, then maybe I'll start to increase my conviction that maybe the worst is behind bonds, at least for the intermediate period. And that'll be interesting to see whether that develops into a trade.
It sure will be, Patrick. And listeners, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading, Patrick's trading service. You can get the information on pages 8 and 9 of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.